Welcome back to A Bite from the Money Sandwich, where we provide practical and easy to understand tips and ideas on how to manage your money better, so as to let you retire with comfort and on your own terms. When you hear someone talk about the economy, all you hear is interest rates, inflation, and investments. But what does this all mean? Today, I am joined by Qian Wang, who is the Chief Economist of Vanguard Asia Pacific. Qian and her team conduct research on the global economy with a focus on the Asia Pacific region, the global capital markets, and related investment topics. Qian talks to me about the current global economy and what to look out for in 2024. She also shares her views on the importance of asset allocation within your own investments. Well, good morning, Qian. How are you?
Good. Good morning.
Yes, and I do realize you've been very kind. You're doing this all the way from Pennsylvania, so it's evening for you, so I do appreciate your time. And for our listeners, you hold a terrific position in Vanguard, and Vanguard's one of the world's biggest investment companies. I actually read just the other day there's over 30 million investors with Vanguard. So I wouldn't mind just getting a bit about you, your background, why you became an economist or what that. I've got two daughters, both love mathematics, and I do see there needs to be more women in the finance industry, as I'm sure you've seen. Just a bit about yourself would be wonderful.
That's great to know. Thank you so much, Mark. It's a wonderful pleasure to join you today. To a certain extent, I would say my life has been a journey. I actually come from a very small town in southwest of China, where we have the best rice wine in China called Maotai. Not sure
Really?
if
Oh,
you heard
okay.
about that. Yeah.
I haven't.
And also, my province, they have the per capita GDP very low, only second to Tibet. So that's my hometown. Actually, the meaning of my name, Qian, is my hometown, kind of like Vinci for Da Vinci.
Oh, okay. And also, I've heard it also has something to do with money as well, isn't it?
Yeah, that's a pronunciation, right?
Yes,
That's a pronunciation. So that's give you a little bit incentive to learn Chinese, right? So
absolutely.
Qian pronounced exactly the same as money in China. So you can imagine how popular I am in the trading desk.
Of course, of course.
So, Mark, you asked me about my career, right? I would say curiosity is really what's driving my career choice and development. I remember in the early 90s, when I was in college, China just started the transition to a market economy. Yet in college, the teacher was still teaching us Marxism, where only labor, not capital, creates value. And then I wonder, if capital doesn't really create value, then who is willing to save and make investment at all? So,
That's
you
true.
know, so that's when I decided to travel all the way to the US, first in Duke and then Stanford to study economics, right? Then after I graduated, I've been trying to get closer to the real world. Starting from a university professor in Hong Kong to the Greater China economist in JP Morgan, and then the director of research in the Sovereign Wealth Fund. I actually have a lot of questions about investment at that moment, but eventually when I joined Vanguard in 2014, first in the Hong Kong office and now in the United States, I'm happy to say that I find answers to a lot of my questions.
Yes, and you must take an interest, because especially from Australia's point of view, China being our biggest partner, economic partner, it's especially since the 90s, the middle class of China has just boomed. It's just amazing.
Yeah.
And that they're definitely not thinking of those Marxist principles now.
Yeah. Well, I think there's a lot of interesting thing going on with China, right? After 1980, they opened up the economy and to start the market reform. You pretty much see an economic miracle, right? I mean, economic growth averaged 10%. Over 10% actually before the global financial crisis. So that's amazing. But I think over the past several years, you also see the economic growth has decelerating quite significantly. There's quite some structural, external headwinds to this economy. So, but I think to a certain extent, you are going to see the fading catch-up effect, right? When the economy become bigger and per capita GDP level gets higher. So I would say, we probably will get used to China's slower growth down the road. And this is something we say China is a bit different from the rest of the world when everybody is saying that interest rate is going to stay higher for longer. In China, it's actually lower for longer, partly because of the lower productivity and trend growth.
Yeah, and my first visit to China, because I have a background, same, southwest of China, and first visit to there was 1982. And you could just
Ooh,
see it was just opening up to the west, I suppose. Fascinating to see, but I've also been back probably about half a dozen times and just seen the change of, especially
right.
places like Shanghai and Beijing, just incredible. So closer to home,
Yeah,
especially the last few years. You've seen, your job especially has been a very tough one because, the last 4 or 5 years
indeed.
has been an awful, awful time for a lot of people. COVID, we came out of COVID and, the cost of living that's been going up. We've had high inflation. Anyone who's got a mortgage is really feeling it right now. So maybe just giving your view just on the last couple of years would be probably worthwhile before we just sort of move into,
Yeah,
2024, a bit of look at the
right.
past.
Yeah, I mean, thank you so much, Mark. I think, over the last several years, one lesson I definitely learned about being an economist who's, trying to make forecasts is to be humble, right? There's so much uncertainty in the world, and so that's where, in the end, I feel like in terms of Vanguard's forecasting approach, right, both in terms of economic forecast and market outlook forecast, we actually talk about different scenarios, right? And we talk about the probabilities, going forward. So I think our forecasting framework actually suits really well in this kind of very uncertain market environment. Now, when you look at the past few years, it started with pandemic, right? It's one of the most pronounced economic shock in nearly a century. Then what you have is aggressive policy support really helped to engineer a strong rebound in the economy, especially after the lockdown measures are being removed. So
Mm.
when we look at the Australian economy, it was really hit hard in 2020, right? Especially in the first half. That's the first year of negative economic growth since 1991. But then you see that the economy rebounded pretty quickly after that. Now, those unprecedented policy stimulus actually had unintended consequences, right? So, those policy stimulus coupled with shocks on both demand and supply side has triggered a sharp rally in inflation across the world. And then that gives the central banks no choice but to tighten the monetary policy very aggressively and swiftly. Right, so this is where we see, in just the 2 years, we see the interest rate has been, hiked aggressively in Australia. Back in 2020, you have like 0.1%, and now we are seeing 4.35%, right, to curb
Mm.
inflation. So, I think this year, 2023, is oh, sorry, actually, that's last year. So last year, that's a year we have seen significant progress being made on in bringing inflation down from their generation highs. Some of that I would say is actually good luck, right? You have lower oil price, you have global supply chain that's normalizing. Right, the disappointing recovery in Chinese economy last year actually was a good news for the rest of the world to a certain extent because it helped to export a lot of the goods deflation, right, to the rest of the world. But I would also say some of that is also because of the good policy, right? Central bank, because of this very aggressive hikes, they actually regain their credibility. Right. So, inflation expectation remain very well anchored as a result. And also, monetary policy is becoming restrictive. That actually start to, bring inflation down. So, for example, in Australia, right, we are seeing inflation lower. Right, monthly headline CPI is down to 4.9%. Then I think probably like today we are going to see the November data, right? But you see, the lower inflation come with a cost, right? Growth pace is decelerating, right? So still positive at this moment, but now it's coming below trend. Consumption is subdued and corporate profitability is declining. Relative to what we see in the US, I think Australian economy is actually much more sensitive to higher interest rate, right? Because the majority of household debt, they are variable rate or actually fixed rate, but very short term.
Mm.
So
And
this
that's,
is what we
just
are
on
seeing.
that's unique to fairly unique to Australia, because it's not the same way in America. Debt is mostly household debt.
Yes.
Yeah,
I think in the US, what you see is that the household debt actually, especially after the global financial crisis, right? So literally, you see the household is trying to clean up their balance sheet, right?
right.
So relatively speaking, household, in the US is not heavily leveraged, especially when we compare to what we see before the global financial crisis, the subprime crisis, and also I think over the past several years, past decade, almost 90% of the US debt, household debt, is actually fixed rate. So
Okay,
that actually helped to insulate them from this higher interest rate, over the past 2 years.
right.
So, I think at this moment, right, I mean, we haven't seen the end game yet, right?
Yeah,
Inflation is down, but not yet to the target, right? And then the question is, what does it take to eventually bring inflation back to target? And something has to give, right? Then you need to pay some cost. That's economic pain. But the question is how big the pain will be, and whether the economy will get into a soft landing or a hard landing. Right,
yeah.
there's a lot of hope of soft landing, especially given how the economy has fared well, over the past year, especially in the U.S. Right, so I mean, at this moment, I think people are still like, we are still waiting to see the
Mhm.
end game.
So on that, and you said a really good point in that, how much pain is it going
Yeah,
to be? But for a lot of people that I talk to, listeners, people I coach, it's how long is that pain going to
right.
be there for?
Yes,
So we're also already starting to see, people in 2023, and there's always when interest rates go up and people are panicking, they say, "Oh, this will be, it'll keep going up to double digits. It'll keep going for the next 5 years," and they panic. And there's always that type of
right.
commentary. But realistically, we're not going to see double-digit interest rates like we did in the 80s or
Yeah.
90s. No, they'll never get that. But also, it would be good to get your view on how long you see, because people are sort of saying, "Oh, by the middle of 2024, we'll see significant drops." What's your view on this, the actual timing of all this?
Yeah, I think now this is really about inflation, right? So I think there's a lot of hope that, oh, central bank will cut interest rate early, right? So for example, in the US, the market is already pricing a 60% chance of a cut in March,
Right.
right? We don't think, central bank will rush into easing, into interest rate cut at this moment, especially given the high uncertainty about inflation, right? We always say that 1 month does not make a trend. And then, so, central banks, number one, they really want to have very high conviction that inflation is really convergent to the inflation target, right? 2% in the US and 2.5%, that's a middle point of the range for RBA, right? And second, I would say, they may need some really significant easing in the labor market or the economy to break, for them to have an early cut, right? We don't really see that at this moment, right? So coming to the inflation, one thing I would say is that there's still some way to go, right? Inflation is still above target. Right. And then I would say if you look at the core inflation, especially on the service side, it's very sticky, right? And the wage growth is still high. So on that front, I would say if the central bank does not keep the monetary policy restrictive enough, right, long enough or high enough, then there is indeed a risk that the inflation actually could stuck around 3%, or for the US, or 4% or higher in Australia, right? So on that front, I think the risk, what do we see? The risk is still tilting towards that there could be upside risk to inflation. One, I would say there could be renewed supply shocks. When you look at it, right? Yes, goods deflation has been a main driver of disinflation last year, but most recently, you saw that global shipping cost is rising because of the tension in the Red Sea, right? So, and remember, 2024 is the largest global election year in history. So that might keep the geopolitical tension elevated, right? And that could bring renewed shocks to the global economy and inflation. And the second thing I would say is that another risk is if central bank, come up with a premature rate cut, they cut too early, too fast, right? Then in this case, when the labor market is still tight and when the economy is still pretty resilient, then that could reignite the inflation and central bank could hike again. So one example I would say, especially in the US, is that going back in 1967, Fed thought we had a soft landing. So Fed actually cut interest rate. And then just 1 year later, the economy overheated again. Inflation reaccelerated to 6% in 1969. And then the Fed has no other choice but to hike again, which eventually pushed the economy into a hard landing. Right. So I think central bank is learning the lesson from history that you don't want to win a battle but lose the war.
Yeah, no, I totally understand. And just from an Australian perspective, Australian basically follows what's happening in the US. So,
Yes.
we're very clear. The Reserve Bank here is, just watches very closely what the central bank does.
Yeah.
There, we've just seen, and when you're talking about has to try and keep inflation down, which in our terms is especially keeping interest rates up. Which stops people spending money and which drives inflation. We've just had Christmas. And we've had Christmas, we've had the Boxing Day sales, we've even now have the Black Friday sales, which was an American thing, but we now have them in Australia. So it's a very fine balancing act that we're trying to stimulate people going out and spending, all the advertising there, but we're having high interest rates to try and stop people spending, to try and keep inflation down. But if we do you see 2024 as probably at least a better year? We saw a lot of rises in 2023. At least you're saying maybe we're going to try and see a bit of light at the end of the tunnel now, 2024.
Well, I mean, in terms of the economy, I would say, we are expecting the economy to actually go, economic downturn. For major economies in the world, right? For the downturn. So in the US, we are actually expecting a milder recession, right? So that's where the monetary policy will eventually bite. People don't feel that in 2023 yet. Why? Because there is a long and viable, monetary policy transmission. Right? So you just have to wait, and then there's some other offsetting factors that actually is keeping the economy, growing. So I think in the US and in Europe and in UK, we are going to see a minor recession in 2024. In Australia, we are also going to see the economic growth to decelerate compared to 2023. Right. So you have weaker growth because of the monetary policy will start to bite. But I think in Australia, we have confidence that a recession is likely to be avoided. So this is somewhat different from what you see in the US and elsewhere.
Okay.
Right. So I think this is largely because in Australia, you are a commodity exporter, right? So you are going to get some support from, solid commodity price, in particular, as we just discussed about China, right? China is going to stimulate the economy mainly through fiscal spending on infrastructure, public housing, urban village renovation. All of that involves a lot of, say, demand and import for commodity industry metal. That will actually help to provide some support to Australian economy, right? And also one thing I would say is that relative to US, actually, monetary policy is not that restrictive. So when you think about Australia, we have 4.35% interest rate at this moment, and we believe the neutral equilibrium interest rate is about between 3 to 4%, right? That's similar in the US, yet the US policy rate right now is over 5%, it's almost 5.5. So monetary policy is actually less restrictive in Australia. So to that extent, we feel like the economic pain will be less in Australia compared to what we're seeing elsewhere.
Good. That's positive news. Uh,
Right,
so just moving on, I see that one of your roles is part of the strategic asset allocation team. And for
right,
me, that was something when I first read about this from Vanguard, probably 10 years ago now. Um, that was for me a game changer, because I really, more than people trying, oh, I'm going to try and time the market, or I'm going to,
right,
just watch and do different systems on how to beat the market or to always keep ahead. Strategic asset allocation is proved that where you invest and having a long-term investment is far more important than any other
right.
strategy. Do you want to just have a very quick explanation of what strategic asset allocation means?
Allocation. And in Vanguard, we leverage on our proprietary models,
Right.
including Vanguard capital market model, Vanguard asset allocation model, Vanguard life cycle model, to understand the risk return profile of each asset classes and their correlation. Then we help investors to find the right mix of asset types for investors based on their investment goals, your investment horizon, and also the risk tolerance. Right. So we come up with this asset mix, and then, for your long term investment. Right. So that is what we call the strategic asset allocation. Right. And once you have that asset mix, unless your investment horizon, your goals, or risk tolerance change, then you pretty much stick to that plan and you rebalance when the market changes. So I think research from both Vanguard and well-respected academics has shown that over 90% of the variability of a portfolio's return over time is determined by strategic asset allocation. Right. So SAA, that's what we call, is actually the most important thing for your long-term investment return. On the other hand, short-term tactical investment decision, timing the market,
Mm,
or security selection, they actually have relatively little impact over the longer time frame. Right. So that's why we actually put a lot of emphasis, say, let's first get your strategic asset allocation right. That's the core.
And to to give an example, a growth investor in Australia would have probably 70-80% of their assets
Mhm.
in shares, overseas shares, Australian shares, and 20 or 30% in defensive assets, and bonds, term deposits. Uh, and just having that mixture right is having that
Yeah.
asset allocation. But for me, it's what I find about, especially for Australia, is how frustrating it can be that so many people, especially in superannuation, have a very defensive asset allocation. When
Ah,
superannuation is such a long-term investment, the
right.
default fund, for example, is a balanced fund. So
Yeah.
therefore, balance, it should be 50% growth, 50% defensive. And if you've got a
Right.
30, 40-year time frame with superannuation and retirement, that doesn't fit at
Right.
all. And yes,
Yeah. First, I think, Mark, I really like the idea, say, having a balanced portfolio, right? In the same way, finding a balanced lifestyle is
that's exactly
conducive
right.
to
It
good
sounds
health,
good.
right? Finding balance in the investment portfolio gives investor the healthiest chance of achieving their long-term goals, right? The question is, what is the right mix? Right. Because you hear a lot of people talking about 50-50, you just mentioned. And, in the investment world, we talk a lot of people talking about 60-40 as well. Right. So, what is the right mix? Well, to a certain extent, I would say it's not a one size fits all, right? It's really depending on your investment goals, your time frame, your age, right, and your so your investment horizon. So I think you know it could be different for everybody. Investors are able to choose generally between constructing a conservative, balance, or growth portfolio. I mean, there is no good or bad allocation. You just need to find the one that's really right for you based on your own situation. Right. So if you are young, you have a very long time horizon. So that means you have enough time to wait for bad market to recover, right? Then you can have higher allocation to risky assets like equity that's more volatile, right? They could have a very bad year, remember in 2020,
Mm.
but you can just wait, and then they will come back. So one thing I would say, remember the last 4 years is almost like a roller coaster, right? The market come down and back, but by the end of that period, we still end up with decent return, right? Like ASX 200 increased by about 14% from 2020 to 2023, and YSE composite actually increased by about 20%. So when you have that kind of longer time horizon, then you can actually go for a higher risky assets allocation, right? So that's where we have growth portfolio for this kind of uh, investor who have longer time horizon. Or you say, maybe I don't have longer time horizon, but so what? I have higher risk tolerance.
Mm.
Even in that case, you could also have higher allocation to risky assets as well.
And also, people I think get scared off because you say risky, because it is risk
Yeah.
tolerance and all that. And whereas when people looking at these equities, this is not risky stocks in that these are your four big banks. This is BHP, this is Telstra, companies that have been around for a long time. So yes, they will go up and down, but over time they have performed well. So that risk, people have to say, yep, when equities does have a risk, but over the long term, they have performed well. Also, when you're leading a point, that very last point, which is a very good one, is that your risk tolerance may be that yes, you would rather have more growth or type assets, or happy to take a bigger risk. One of the things I'm very concerned with is we're all living longer, and so even people traditionally who are retiring, there is just that thought pattern that, oh, I should become more conservative. I should put my money into cash because I'm retiring and I don't want to lose it. Whereas, you might have another 30, 40 years to live, and you need your money to work hard and last as long as you do.
Right. Well, I mean, a long life is really an amazing blessing, right,
Mm.
for all of us. But without proper planning, it can indeed disrupt, our long-term retirement plan. Now, first thing I would say is that, as we discussed earlier, right, the asset allocation will be different for everyone.
Mm.
Age is a very important consideration because it is a proxy for investment horizon, right? It's not really just about your age; it's about how much longer your investment horizon will be. So theoretically, when we get older, we do want to be more conservative as investment horizon will be getting shorter. However, when you are talking about this longevity risk, if we do believe that we are all going to live longer, then that probably means even at the same age, my investment horizon is also longer than we previously
Yes.
thought.
Mm.
Right. So in this case, I think even retiree may be able to afford to have a higher allocation to risky assets, depending on your risk tolerance and goal, of course. And the second thing I would also want to highlight is that this may be a piece of good news for all investors and especially for retirees. If you read our 2024 VMO, that's our Vanguard Investment and Economic Outlook, we are highlighting a structural shift towards higher interest rate environment,
Right.
right? Right, because of some of the fundamental changes in the economy. Basically, we see because of demographic changes, because of a structural fiscal deficit, there will be less people saving, but more people spending and borrowing, right? So given that, interest rate is really a price of capital. When there is less supply of capital because less people saving and more demand for capital, interest rate will be higher in the future, right? So that's why we say, even central bank cut amid of an economic downturn or minor recession this time. But beyond this business cycle, we will never go back to the low interest rate or zero interest rate that we have seen in the post global financial crisis era. This, in our view, is the best financial development, over the past 20 years. Why? Because higher risk-free rate basically provide a very solid foundation for higher risk-adjusted return for all investors, right? So this actually, at this moment, when we look at our return outlook for the next 10 years, right, we make that forecast. We see our return outlook has improved significantly, especially for bonds. especially for bonds, right? For example, when you look at the Australian, bond market, a few years ago, the expected return, annualized return for the next 10 years is like what, 1% to 2%. Right now, what we actually have around 4.3 to 5.3%. Right, so this is actually quite a good news for all investors, especially I would say for retiree who generally have a more conservative portfolio. Right, so at this moment, I would say bond return outlook has improved significantly, and equity risk premium actually is still very compressed. Right, so even for an average investor, we would actually advise our investor to be more defensive in the portfolio. That means more allocation to bond market. Right, so in this case, frankly speaking, it's not necessarily a bad choice for retiree to keep a conservative portfolio, even with a longevity risk.
No, that's an excellent point, because we're so wrapped up for a lot of people about they've got mortgages on their homes, so they're worried about the interest rates going up. But actually, on the flip side, for retirees, they virtually, if they've had their term deposits or investments in the bank, they've been virtually getting nothing for so long now that they'll actually get a decent return. So no, a very good point. Qian, I've taken a lot of your time, so I really appreciate you being here and answering the tough questions. One of the things I actually love asking as a final point is asking, what's the best piece of advice you've ever received, whether that's financial or life? It'd be interesting to know what you've had.
Oh, thank you, Mark. I think we can go on and on. I really enjoying our conversation. The best advice for my life, seriously, is like focus on what you can control and let go what you can't. Seriously, this helped me a lot when dealing with two teenagers in my house. Now talking about your two daughters, right?
Yes.
And of course, I think this applies to investment as well. Right. So, I mean, the market is keep changing. There's a lot of things that you cannot control. So focus on what we can control. We can control our strategic asset allocation. We can control, go with low cost of investment. Right. But market performance is not something that we can control. Right. So eventually, I think it's ultimately the Vanguard message that we stay on course and stay diversified, and don't look at your investment account every day. That will help you sleep better every night.
That's a very, very good point. Both that last piece as well. I must admit, teaching and coaching my clients, so sometimes just sit on their hands and do nothing is the hardest thing to do sometimes, especially for a lot of men who want to feel like they need to do something when they see the markets are going down. But sometimes you've just got to stay the course and do nothing and wait it out. But so no, terrific piece of advice. No, thank you again for being on the show, and hopefully we can talk again soon.
Definitely. Thank you, Mark. Bye.
Bye-bye. I hope you enjoyed this episode. If you'd like to know more about Qian Wang and the work Vanguard do, especially in Australia, visit vanguard.com.au. So it's vanguard.com.au. Or you can feel free to email me on admin@themoneysandwich.com or visit our website, themoneysandwich.com, if you have any questions or would like to learn more. Enjoyed this episode and want to hear more of A Bite from the Money Sandwich? Make sure you subscribe on your platform of choice so you can automatically receive each episode as soon as it's released. As with every podcast, this information is not advice, as not personalized to your own situation. And past performance is never guaranteed for the future. What we are trying to do here is to provide tips, coaching, and education to help improve your money knowledge, which we believe can only be a good thing. See you next time when we take another bite from the Money Sandwich.